right, we're joined by Thomas Hayes, our good friend from the chairman and managing member of Great Hill Capital. We got to get through banks, inflation, rates, and your top picks. So let's start with banks. What the heck happened with SVB? I think we have a general analysis on it, but I feel like it's bled through to the other banks. There's obviously been an impact. The banks came back a little bit, but there is still some drama yet to be unfolded.
Well, Phil, like Warren Buffett says, you never know who's swimming naked until the tide comes out. And that's exactly what happened with Silicon Valley Bank. They had the highest percentage of uninsured deposits at 97%. It was all hot money. They cater to startups and venture capital funds. So the minute they had a whiff that there was going to be an equity raise and there was a problem with capital, they all fled all at once. You know, their deposits exploded during the pandemic boom for tech, over $200 billion. They put about $128 billion of that in relatively conservative investments, 5.7 years average duration, U.S. Treasuries and government-backed mortgage securities. But then Powell went on a rampage and he just started raising and raising and raising and raising. So believe it or not, it's kind of like you buy insurance from the insurance company, they set your house on fire, and then they say, what did you do? And that's part of what happened here and what they had to deal with. They had a $17 billion unrealized loss. If they held to maturity, they would come out at par, but they had unrealized loss. And with all the deposits fleeing, they had to sell some of those and actually make an unrealized loss realized. Then they wanted to raise another $2 billion of capital at the same time, and it just all fell apart. Last Tuesday, Wednesday, there was a rush to the exits.
I think we're following you on this. What investors are asking is this just SVB and I guess Signature Bank as well? And do other banks have the same problem or do they not? Because we've heard from experts they don't have this problem, but then look what the market did today. It didn't really react in the way that perhaps some people thought it would because people are still very skeptical. Why? Yeah,
well, if the Fed's lending facility, it's called the Bank Term Funding Program. That's what they came out with over the weekend. If that was in place last week, Silicon Valley Bank would still be in business. And so potentially with Signature Bank as well, although they had some more crypto exposure and different things. But basically what happens with that is even if you have the unrealized loss, you can borrow from the Fed at the full value of your securities, what they would mature at because they're treasuries or they're government-backed securities, and they wouldn't have had to go out and raise capital even though the deposits were going out. Now, I do think the Fed is probably going to have to do one more thing, and rather than just implicitly guaranteeing deposits, potentially explicitly guaranteeing deposits, because right now there seems to be an incentive to move your deposits if you're a big business. Relatively smaller individuals and so on are staying in their banks and they're all staying put and there's no big deal. But bigger businesses, I think, are starting to move to the big four systemically important banks, and that's not really healthy for the banking system. So I do think we need to see some policy come down and say, we are going to have some level of backstop for unlimited deposits so that those deposits stay spread over the entire banking system versus just going into four banks.
Having gone through the financial crisis in 2008, a lot of people talked about compliance, risk management. Things were supposed to be so great, right? Look, I get it. You're saying rates went up. They've been going up for a year. They've had a year to get ready for whatever they were expecting to have happen. It didn't happen just yesterday. So blaming the Fed, yes, they're not necessarily to blame, but they're part of the cause. But they had a whole year to manage this risk. Where's this team?
Yeah, well, there's no question there were shortfalls, particularly at Silicon Valley Bank. And that's why you say when the tide goes out, you see who's swimming naked. You know, they had an article that they had the person who was helping clients was overseeing cases for the employee's psychology. So not exactly a focused employee on risk management, and that's evident in the results.
All right, real quick, where do we go from here? People are talking about no rate hike. We had those inflations number that came in today. Markets seem to be okay with it. And then what are we supposed to do with our money? Are we supposed to panic or are we not supposed to panic?
No, there's no reason to panic. You'll have a few little aftershocks here, but moving forward, we've gone from expecting 100, the market has gone from expecting 125 basis points more of hikes to now we've got like an 80% chance, I think, as of the close, of one more 25 basis point hike next week, and then that's done. And there are others saying, like Goldman, they should do no more hikes. I happen to agree with Goldman. We'll see what happens, but 25 basis points probably wouldn't be a reason to do it. But even so, what we know is now the pause has moved a lot closer.
Right.
And if that's the case, where do you want to be? You want to be in tech. Get some tech exposure. Some of these high quality businesses. We've talked about Amazon before.
Give me real quick 2 names you would buy right now.
I'd buy Google. It's trading at 15.2 times 2024 earnings with 20% earnings growth. They're going to cut about 12,000 jobs. It's down 50%. I think that's a safe bet if you look out 1 to 2 years. Sure, some short-term slowing, but long-term, it's a quality franchise. They've got more AI than Microsoft could ever dream of. It's just not widely available yet. It will be. And then Bank of America, they're going to benefit from all those business deposits. They're trading at 8 times earnings, trading at a discount to book. So that's kind of interesting to us here as well.
Google and Bank of America. Thomas Hayes, as always, thank you very much.